Hi there, this is Frank Salo with FTSIG. Part of my business is helping families determine how much life insurance they need to purchase. The purpose of this video is to walk you through how to use a life insurance calculator and discuss some of the important questions that you're going to want to ask yourself while inputting the numbers and going through this process. That being said, this is for educational purposes. This is not to replace an actual conversation or an actual needs analysis that you're going to want to have with a licensed life insurance agent. If you don't have a current agent, feel free to reach out to us. We may be able to help. You can reach us at www.ftsig.com. The number one question I get when I meet with a family is, how much life insurance do we need? The Wall Street Journal recently reported that 58 million households in the United States are underinsured, and 38 million adults in America have no insurance, which is quite alarming. One of the reasons I think this might exist is because a lot of times people will do what other people tell them to do, whether it be the family members or their boss. Their brother-in-law said they only need 500,000, or they read something online that says all you need is 2 or 3 times your income, something that's fairly arbitrary and may or may not really pertain to them. The purpose of this calculator will put you in control and allow you to determine what you want and what you don't want covered. This way, when you meet with an agent, you'll be a little bit more educated in having this conversation. And who knows, it may decrease the amount of time you actually have to spend on going through the needs analysis. Okay, so one of the website that I have up, and the one that I recommend to a lot of my clients, is a site called www.lifehappens.org. It's a great resource for all your insurance concerns. It's non-biased, meaning it's not pertaining to any company. It's just straight information and stories and videos, and there's just a wealth of information that you can find here. I use all the calculators that they have. They're great. They're in-depth. They basically cover everything from soup to nuts. You'll see the life insurance needs calculator. You can also find a link to this on our website, but you'll just click here, and there we go. Just gonna take a second. Maybe not. Let's see, here we go. Just give that a second to load. You can also download it for your phone over here. Walks you through. It's fairly straightforward and easy. So you scroll down, you see the first question is final expenses. This is for burial costs and funeral costs. 15,000 is a little bit light, I think, nowadays. But it's okay. It's a decent number. If you think more or less, you can change it. Outstanding debts other than your mortgage. This is going to be credit card debt, home equity loans, car loans. The other thing here you want to look at is if you have student loans, and whether or not they're federal or private. If they're federal, they may not be transferable on death, so you wouldn't have to include them. You're going to want to look at the loans closely. If they're private loans, I can almost guarantee you that they're going to be transferable on death, so you're definitely going to want to add them here. We'll just put a number in of 35,000 of debt. Outstanding mortgage is just simply how much you owe on your mortgage. College funding. The reason why I like this is it's very simple and straightforward. You just put your child's age. We'll say in this scenario it's a 4-year-old and a 2-year-old, and you pick public or private. Obviously private, there's going to be more funds available in life insurance proceeds. The next question is the biggest question on this calculator. It's the one that often gets overlooked by a lot of people, and a lot of assumptions get made here which can lead to gaps in coverage. It's total annual income your family would need if you died today. So let's assume we're talking about a husband who makes $100,000, the wife doesn't work, the family is totally dependent on that income. Obviously we know from up here that the mortgage is going to be replaced, so that's a good thing. That's one bill we're not going to have to pay every month. Keep in mind taxes on the property will still be owed, so you're going to want to factor that in. You're going to want to subtract that out. A safe number, if you talk to a lot of planners or financial experts, is 75%, but I've also met some spouses who said they can't live on 100%. It's really a conversation that you're going to want to have. The one thing I would hesitate in doing, which is often a mistake, is assuming that the surviving spouse can go out and just find a job after not being in a job market for so long. Usually when you're talking about a healthy couple, they spend a lot of time together. The only thing that's going to wipe them off the face of the earth is an accident. So let's say that accident occurs, the husband dies, the wife's left over, she has 2 children. Now she's not mentally or physically the same person she was from the accident, and now she's supposed to go out and find a job, take care of the kids, and she's also supposed to find somebody to marry her. It's a difficult situation for somebody to accomplish all those things in that scenario. Just some things that you're going to want to think about when talking about the annual income. But for now, we'll go with 75%, which is 75,000 in this scenario. How many years would it be provided? Let's assume we're talking about two 35-year-olds. Well, normal life expectancy is 85, so it would be needed for 50 years. What is your current savings and investments? Not including retirement funds. This is CDs, savings, checking accounts, also brokerage accounts, mutual fund accounts, any investment accounts that you have outside of your retirement accounts. So let's say there's 30 here, 30,000. And then your retirement savings, that's IRAs, 401ks, things of that nature. We'll say there's 50. What is your current life insurance in force? If you don't have any individual coverage, you'd put 0. I would hesitate to put any group or work coverage that you have because your company may cut back on benefits, or you may switch jobs. You may go into business for yourself. You may not have the access to group coverage. So if you don't have individual coverage, I would just put 0. What's your spouse annual income? In this scenario, we're talking about someone who's not working, so that would be 0. If the spouse works, you can put that in here. You also want to figure out her marginal tax rate. The one thing I would also maybe build in here, if the spouse is working, is also a grieving fund or grieving period. Is that if a spouse loses their other spouse, they may not want to go back to work immediately. They may want to take a year off and just spend time with the kids. I'm not sure how I would respond. Sometimes, people want to go back to work instantly, but it's something to think about. If you want to have that option, you may want to build an extra 100,000 or 200,000 in here, just in case you don't want to go back to work. The next question down here is estimated inflation rate. The 75,000 up here, as you know, every year is going to be worth a little bit less with inflation. So historically, if you look at inflation rates, they're between 2 and 4%, which is why 3% is a good number here. After-tax net investment yield, I'll talk about this a little bit more, but I've never had a surviving spouse that wanted to take a gamble with all their life insurance, with all the money that they had left to live on from a life insurance payout, which means that 5 to 6% investment yield is fairly conservative. I would not go I wouldn't go higher than 6%. And if you put something higher than 6%, you're going to have to rely on the stock market to bail you out, and hopefully that it's going to perform at that rate. And you're going to have to take more risk, and if it doesn't happen, then obviously your family's going to be at a greater risk. You're going to click analysis here. And so now it breaks down everything that you put in there. A lump sum from the life insurance would come in and immediately pay off for final expenses. The outstanding debt would get paid off. The mortgage would get paid off. A chunk, 237, would go into a college fund that would grow until the kids needed to go into college. So you need a lump sum payout, or you need an immediate need of roughly 687, and then you have the income needs that you described, 75,000 for 50 years, increasing at 3%, and the investment yield of being 6%. This doesn't mean that the life insurance company pays you $75,000 for the rest of your life. What happens is there's a chunk of money. You can see the present need for the income would be $2 million. So in this scenario, $2 million would get paid out to the spouse tax-free. They would meet with a financial advisor, and the financial advisor would come up with the best way, the best vehicle that would be available at the time that would kick off a $75,000 a year income for the spouse. Would go up 3%, and then would only have to go in at 6%. Some people like to use things called single premium immediate annuities here. Basically, the spouse would forego this $2 million. She'd give it to an insurance company, and then the insurance company would pay her $75,000, increasing at 3% for the rest of her life, as long as she lived. There's also ways that it can be built in where the $2 million would be payable if she died a year later to make sure that all that money's not given up. There's pros and cons to each, but again, a spouse is going to want to meet with a financial advisor and determine what's the best course of action at that time. But like I said, the insurance company, from the life insurance company, doesn't pay out the $75,000. It's what happens after with the money. If you have any questions on that, feel free to email me at frank@ftsig.com. I'd be happy to help. So you can see here, $2 million comes in for the income needs. The lump sum is $687, which is a 2.7 number. You take out what you currently have in investments or assets, which is $80,000 in this scenario, less the income of the spouse, where in this scenario they're not working. It leaves a need of life insurance for $2.6 million. For a 20-year term policy for a 35-year-old male, it's roughly about $150 a month, depending on their health and some other factors that may be there. If that's not in your budget for life insurance, you're going to have to go back and carve out things that you can't have covered. It's better to be underinsured than uninsured, that's for sure. The first thing that you're going to want to take out is college, if you can't find the budget to purchase that. And the reason is your kids can always get loans to go to college. No one's going to give you a loan to pay your bills. If that still doesn't do it, maybe you'll decide that you could cut back and say, well, maybe we'll only live on $60,000. And then you click analysis. You'll see with those two changes, there's no college funding here. There's the $60,000, and then the total proceeds, it knocks it down to $2 million. If that's still not in your budget, you go back and you keep taking things out until you get to a number that makes sense. I don't recommend it, but like I said, it's better to be underinsured than uninsured. I hope this was helpful. If you have any questions or you're looking for this calculator, you can find it at www.lifehappens.org. If you're looking for a quote, if we can help you, you can send a quote to quote@ftsig.com or just visit our website. Thanks.